Hi, my name is Peter Chase. I'm a business and tax lawyer at Truelove D & Chase in Boston. I'm speaking here about structuring business sales. I'd like to emphasize, despite being located in Boston, there's nothing I'm saying here today that is specific to Massachusetts. I can and do represent clients all over the country. So in particular, I'm going to discuss the relative advantages and disadvantages of structuring a business sale through an asset sale or a stock sale. And since we're talking about stock sales, we're obviously talking about selling a business that is operated through a corporation. I will discuss selling a business that's operated through an LLC and a few other issues in a separate segment. The structure of a business sale is determined by the relative bargaining positions of the parties. Essentially, what is good for one party is bad for the other party. And as a practical matter, the vast majority of sales of small businesses are structured as asset sales. And this is for a very simple reason. The buyer has more bargaining power in most situations than the seller. The buyer is the one who writes the check. But despite the majority of sales being in asset sales, I will briefly discuss stock sales first. Sellers will almost always prefer stock sales to asset sales for both tax and non-tax reasons. The tax reason is that a stock sale is only taxed once at the shareholder level. It is simply the difference between what the stockholder received for the stock and his or her adjusted basis in the stock, and it is taxed at a capital gains rate. And as I'm sure you know, capital gains rate varies, and I'm a tax lawyer, not a political prognosticator, but they're always 15 to 17, 20% lower than ordinary tax rates. And a corporation recognizes no gain or loss when stock is sold. And the primary non-tax reason is simply that the liabilities remain with the corporation in a stock sale. There are ways to contract around this with representations, warranties, and indemnities, and that's how stock sales can become much more complicated than asset sales in the drafting of the agreement. An asset sale, on the other hand, will result, at least for a C corporation shareholder, in a double tax. First, the corporation is taxed on the sale of the assets, and then second, the shareholder will be taxed on the liquidation of the corporation, which typically follows the asset sale. A buyer, on the other hand, will insist on an asset purchase for both non-tax and tax reasons. The non-tax reason is that the liabilities remain with the corporation in an asset sale. And the tax reason is that the purchaser wants to get a step up in basis. They want to write up the basis in their assets. And they want to do this so they can get bigger depreciation deductions or have smaller gain on the sale of the assets. So in an asset sale, the seller is treated as selling and the purchaser is treated as buying each individual asset of the corporation for its own portion of the purchase price. The purchase price is allocated or assigned to each asset of the company being purchased. And these assets include the business name, trademark, customer lists, inventory, machinery, every single asset of the corporation. Now, this allocation is supposed to be by the fair market value of each individual item. But when the two parties agree on that allocation, the IRS will not question that allocation. The IRS figures that the two parties with conflicting interests have come to this agreement. And the allocation in an asset sale is where a lot of the haggling comes in. This is because certain of the assets, such as assets that have been depreciated and inventory, result in ordinary income to the seller. And other assets, such as goodwill, result in a capital gain, and therefore with that differential rate I mentioned earlier. The purchaser, on the other hand, will always want to allocate as much of the purchase price to assets that can be depreciated as quickly as possible in order to get those higher deductions. So the best money you can spend when you're selling your business is to have your CPA crunch the numbers or run the numbers and figure the tax under every possible scenario, because your CPA has easy access to the adjusted basis in each one of the corporate assets. And this is the year where you need a CPA, not someone who holds him or herself out as a tax accountant or a tax return preparer. Now, despite the fact that purchasers always want to do an asset purchase, there are special circumstances where a stock sale will be necessary. These are usually assets such as contracts, permits, or licenses that simply cannot be assigned under their terms. And if the corporation is an S corporation or a subsidiary, it can elect to treat a stock sale as an asset sale under Code Section 338H10. And this will allow the parties, by mutual consent, to treat a stock sale as an asset sale. Selling a business is an extremely complicated process. For most people, it is the biggest financial transaction of their lives. And you will need the advice of a team of advisors you can trust: a business broker, a CPA, and a business and tax attorney. Thanks for listening. My name is Peter Chase. You can find my contact info at massachusettsbusinesslawyer.com.